All right. Good morning, everybody. Good morning, all you magnificent melon heads. Happy Tuesday, everybody. Today's March 19th, 2024. The top story this morning is they have done it. They've finally done it. The Bank of Japan has raised interest rates by a whopping 10 basis points. They raised interest rates all the way up to nothing. Amazing. And the world pretty much doesn't care. Nothing has really happened yet. Big move because it is a famous change in direction. The last time the Bank of Japan raised interest rates was something like 2007. It has been not since before the GFC has the Bank of Japan raised interest rates. They have officially ended negative interest rate policy in the world's third largest economy. And while that is a major milestone, at least numerically speaking, it's a pretty insignificant thing because it was only 10 basis points. The gap between interest rates in the United States and Europe versus what the interest rates are in Japan is still massive. However, it is a shift in direction. They have officially ended negative rates. That was the last place on earth that still had negative interest rates. So may we please, for the love of God, put that stupid experiment to bed permanently. The concept of negative interest rates, it did not work, and it led the world into inflation. I think we've all seen enough data to say negative rates is probably not a good idea moving forward. They also ended their policy, the ultra dovish monetary policy of yield curve control, where instead of saying like what we have here when we did quantitative easing, we said we'll print a quantity of money, like say the $300 billion, and we'll buy bonds with that $300 billion. Instead, Japan says we are going to peg our rates at a certain level, and we'll print as much money as we need to maintain that level. Well, they have officially ended that policy as well. So this is a significant change in policy for Japan in that it is a big signal to the market that the era of negative rates is over. The era of yield curve control is over. However, when you step back from that and the significance of that and the symbolism of that, what you're left with is a 10 basis point interest rate raise from negative 0.1 to 0. Not really a significant event when you look at it from that lens. And right now, the market is taking that later approach, largely shrugging this one off. The yen has actually weakened against the dollar because I guess the market was expecting something a little more aggressive or maybe a little bit more of a signal from the BOJ that there's more to come. And well, it didn't get that. We just got this kind of move. I mean, this is a little itty bitty baby hawk. Like it just hatched and it's still got its mouth wide open, begging up into the air. Mommy, please give me something to eat. That's what that was, this big hawkish pivot from the Bank of Japan. All right, so now all eyes move to the Fed. The Fed is getting together tomorrow. We've got the FOMC press conference. They're actually getting together today. The press conference will be tomorrow. And, well, the Fed is expected to do nothing, but everybody is going to be hanging on Jerome Powell's every word and revisions to the FOMC statements. We're looking for clues about what they might do in May, although, hey, very slowly over the last couple of weeks, the odds of a rate cut in May have gone down to almost nothing. We're only looking at like 5% chance of a move in May now. So it looks like June is going to be when the Fed finally decides to cut rates. And even June is not a sure thing. That's down, it's down to like almost a 56% chance that they cut in June now. That's, as Mish put it this morning, essentially a coin flip that they even go in June here. So the Fed has been drifting slowly more dovish. More hawkish, less dovish, as these inflation prints have been getting worse and worse. And the hot jobs numbers, oh my God, I feel disgusting saying that because the headlines have shown a lot of job growth, but it's fake. And of course, the GDP numbers, which are all being driven by excess government spending and new debt, that has reaccelerated inflation. And so now the expectations of Fed rate cuts are really being dashed day in and day out here. And yet stocks have still not repriced. Stocks are still basically moving higher. I mean, they didn't go higher today. They're a little bit lower this morning. but the market has not yet adjusted to the reality that, hey, best case scenario, guys, we're looking at about 3 rate cuts this year. The market is still priced for 7. They're not going to get 7. Also going on this morning, we've got Nvidia had their big unveil, the new processor that's going to be the backbone of all their new GPUs moving forward. The Blackwell chip was unveiled by Nvidia yesterday at their big GTC conference. That's Nvidia's big, what is it called? The Global Tech, or the GPU Technology Conference, the GTC. Jim Cramer and me, Kevin, everybody's there. Yay, Jensen Huang. They're treating it like a rock concert, which, by the way, fanboy enthusiasm is another one of the hallmarks of the top-end markets. The market kind of shrugged it off, didn't really care. No, look, I'm going to reserve comment on the Blackwell processor because I'm a mechanical guy. I'm not an electrical guy, so I don't know anything about GPUs. But I can tell you, you don't really need to know a lot about GPUs to understand what's going on here. NVIDIA is the victim of its own grotesque successes over these last few months. The expectations are just so high now that at some point, as I've said before, the law of large numbers takes over. It doesn't matter what they do because the expectations are so high, they can never possibly be met. And, trading at 40 times sales, NVIDIA right now, it would have to grow into the quadrillions of dollars of sales to ever meet these expectations. It's just not going to happen. So it doesn't matter how good this GPU is, I guess, is the point I'm trying to make. NVIDIA has had its run. It's probably going to go to 1,000 because every analyst on Wall Street has just decided that it's going to happen, and they're all just arbitrarily raising price targets without looking at anything or any of the shady accounting things that we've talked about a lot on this channel. But the market is shrugging off this news, and NVIDIA was actually down on the announcement of this new chip. Again, it's not a commentary on the technology behind it. It's just the numbers have gotten too big. It's run so far. There's no way to impress at this point when you've already done so much. Also going on this morning, Super Microcomputer, the glorified shelf company, they are announcing that they're issuing 2 million new shares, diluting their shareholders, of course, where their stock was over $1,000 after running up like 1,000% this year. Supermicro has run up even more than NVIDIA. Of course, they're going to issue shares and dilute all of the retail shareholders that have just piled into this company for no reason other than they keep talking about NVIDIA and artificial intelligence. So that one is down 16% in just the last 2 days. It was down 10% pre-market this morning and falling. We'll see where that one goes. But of course, they're diluting and issuing shares there. If you're buying Super Microcomputer, you are exit liquidity, guys. I've been saying that for a while here. Also, speaking of that hot jobs market that left a bad taste in my mouth a few moments ago, we got the rebenching. I believe they call it rebenching of the jobs numbers. California went back and they revised all of last year's jobs numbers from September of 2022 to September of 2023. And where they had previously reported adding 325,000 jobs in the state of California, now they're saying, oh, that 325,000 was actually 50,000. A downward revision of 277,000 jobs. And, well, we've seen that all year, guys. Downward revisions. The headline number gets all the press and the fanboys cheer, and my economic plan is working. Oh, yeah, everything's great. Fed's going to cut rates and all this other stuff. And then a few months later, to no fanfare, oh, yeah, remember those hundreds of thousands of jobs? They never happened. Sorry, our bad, moving on. Hey, this month we added hundreds of thousands more, only to downwardly revise those later on also. Big downward revision from California. And to jump on the pile this morning, we've got Unilever. It's one of those consumer companies. They make everything from soap to ice cream. They have decided that they're going to streamline their business a little bit. They're spinning off Ben & Jerry's ice cream, and they're going to cut 7,500 white-collar middle management jobs. There is that white-collar recession striking again. It's those white-collar, those middle managers, well-paying jobs continuing to go away by the thousands, being replaced by low-wage gig work and part-time jobs. Strong jobs market is a myth. I've been saying it for months, heck, years now. I've been saying it. The world is finally starting to realize it. It is a busy morning going on today, guys. Why don't we shrink my big melon of a head and let's see what's happening in the markets. And don't forget that like button. And if you're new here, subscribe. We do this every morning, so have your coffee with the melon heads. As we go through the markets, in the S&P right now, down 15.5 points or 0.3% lower. Pretty much unchanged on the day, a little bit in the red. The Dow is down 42 points or 0.11% lower ahead of the opening bell. And the NASDAQ is leading the way lower, down 0.55%, 100 points in the red this morning for the NASDAQ. That's being led by that sell-off in the AI names. The DXY, meanwhile, is a little bit stronger this morning. I guess the disappointment at the BOJ move or the collective yawning at that 10 basis point hike at the BOJ has got the dollar a little bit stronger this morning. Currently at 103.9, up 46 basis points. I guess we're pushing 104 here pretty soon. And looking over at the yield curve, we got a mixed bag. The long end is a little lower. The short end is a little bit higher. So we've got even more inversion in the yield curve this morning. The 30-year is at 4.448. That's down 1.8 basis points. The 10-year is at 4.305. That's down 3.5 points. The 2-year is at 4.70, down 3.5 points also. And the 1-month Treasury, 5.397, down 1 point this morning. Looking over at the commodities board, we've got April gold futures are down a little bit, $2,160 for April. That's down $4 this morning or 0.2% lower. May silver futures at 25.08. That's down 18 cents or 0.72%. We have got palladium is down 2.5%. I'm sorry, platinum down 2.5%. Palladium is down 3.5%. So none of the metals are having a very good day today. And then May WTI crude oil futures at 82.25, up another dime this morning or 0.13%. Oil continues its move higher, slowly but surely, now at $82. And check out Bitcoin. The sell-off continuing in Bitcoin this morning, down another $4,300 here, 63,294 for Bitcoin. This is as priced on Coinbase as of 9:13 a.m. this morning. So big red candle down for Bitcoin as the enthusiasm for the Bitcoin ETF wanes. And check out this one. Again, shout out to Zero Hedge, who's been putting out these daily charts showing the net flows in and out of the Bitcoin ETFs. And I got to draw your attention here to these two bars. Looks like yesterday we actually had net outflows from the Bitcoin ETFs for the first time in a while. This big negative black bar right here, that is money leaving the Grayscale Bitcoin ETF. They sold a ton of Bitcoin yesterday. $642 million left that ETF. And we only had net inflows of about $500 million into the other ETFs. So yesterday, the Bitcoin ETFs were net sellers. So that enthusiasm, it appears to be waning a little bit. Still a lot of people buying the BlackRock ETF here. Still net inflows into some of the other ones. But with all that dumping going on at Grayscale being caused by people leaving that fund because of their high fees, that overwhelmed the market yesterday and led to that big downturn in Bitcoin. But let's talk about the main story this morning. Japan ends the era of negative rates. Good riddance, if you ask me, with few clues on further hikes. And I think it's that second part there, the few clues about further hikes, that has the yen a little weaker this morning and has the rest of the market pretty much shrugging this whole thing off. The central bank signals easy financial conditions to continue, and the yen slipped through the 150 level on uncertainty of further moves. The Bank of Japan scrapped the world's last negative interest rate, ending the most aggressive monetary stimulus program in modern history, while also indicating that financial conditions will stay accommodative for now. The bank's board voted 7-2 to set a new policy rate range of between 0 and negative 0.1, shifting from the negative 0.1 short-term interest rate, according to a statement at the conclusion of its two-day meeting on Tuesday. The BOJ also scrapped its complex yield curve control program while pledging to continue buying long-term government bonds as needed and ended purchases of exchange-traded funds. The lack of signaling on any future rate hikes weighed on the yen, which slid past the closely watched 150 mark versus the dollar, while benchmark government bond yields edged lower. So the Bank of Japan is being very, very careful here. All right. Honestly, I expected this move about a year ago. I thought Ueda would come in, hit the ground running on day one. He would start doing this. Of course, Ueda came in, hit the ground running, if you will, on day one, right as banks started failing in the United States. Silicon Valley, Signature Bank, right? All happened early March last year, right as Ueda took over at the BOJ. Now, the reason why those banks in the U.S. failed was because of massive unrealized losses on U.S. treasuries resulting from the Federal Reserve's rate hikes. So in comes Ueda, the new BOJ governor, and he wants to do the same thing the Fed just did. And on day one, he looks across the pond at the U.S. and sees banks failing and says, well, maybe we shouldn't do that then. And so they kept these interest rates. They kept their overall monetary policy very dovish, very accommodative. And now here we are a year later, they're finally moving and they are just barely budging ever so slightly, being very careful not to repeat the mistakes that the Fed made here in the States. And well, just to put this in context, take a look at this chart. This shows the BOJ's policy rate going all the way back to 1980. All right, so obviously we had the high rates of the 80s. That was the Paul Volcker days at the Fed here in the States, fighting the inflation of the 1970s. Rates have only come down for the last 40 or so years. Then in the 90s, you had the big Japanese crisis, the bond market crisis in Japan. And basically, they've been below 1%, essentially nothing really since 1995, 96. But you'll notice the last time this chart moved in the upward direction was right around 2007, pre-GFC. And they haven't moved up since. They had a couple of more rate cuts over the years, right? They cut down after the GFC. They went negative in 2016. And then all the way over here on the right-hand side, can you see it? If you squint, you can just barely see it. If you blink, you're going to miss it. That was that much anticipated massive move at the BOJ that just happened, that itty-bitty little blip right back to zero at the BOJ. So, let's put this in context here as why I showed this chart here. It goes to show you that nominally this move was a non-event from the BOJ. It's really about symbolism at this point. The era of negative rates is over. The BOJ is finally moving in a hawkish direction, but man, they are going to take their sweet time getting there. That's the message here. And well, the yen saw that and said, kind of disappointed in that move. This is the chart of the US dollar as measured in Japanese yen. And this chart is moving higher. That means the dollar is strengthening against the yen weakening against the dollar. That big green candle here, that is the market's disappointment in what the Bank of Japan just did. People are dumping yen and buying dollars this morning, even though we just had an ever so slightly hawkish move from the BOJ. Now back above that all-important 150 level. Now let's shift gears a little bit here to Nvidia. The AI darling. Nvidia unveils the successor to its all-conquering AI processor. You got to love the language in the mainstream financial press here. The all-conquering AI processor. And what wonderful things they've done with it. See some of my earlier commentary on what AI has produced so far. CEO Jensen Huang introduces the Blackwell chips at the company event. The new processor is made up of 208 billion transistors. NVIDIA's CEO Jensen Huang showed off new chips aimed at extending his company's dominance of artificial intelligence computing, a position that's already made it the world's third most valuable business. A new processor design called Blackwell is multiple times faster at handling the models that underpin AI, the company said at its GTC conference in San Jose, California. That includes the process of developing the technology, a stage known as training, and the running of it, which is called inference. The Blackwell chips will be made up of 208 billion transistors. It'll be the basis of new computers and other products being deployed by the world's largest data center operators, a roster that includes Amazon, Microsoft, Alphabet, Google, Oracle. Blackwell-based products will be available later this year. Blackwell is named after David Blackwell, the first black scholar inducted into the National Academy of Science. Has a tough act to follow. Its predecessor, Hopper, which fueled explosive sales at NVIDIA by building up the field of AI accelerator chips. The flagship product from that lineup, the H100, has become one of the most prized commodities in the tech world, fetching tens of thousands of dollars per chip. So NVIDIA has unveiled their new Blackwell chip. It's going to be awesome. Honestly, I don't really speak GPU. So the 208 billion transistors, wow, that's a lot of transistors. I don't even know what that means. But I can tell you the market looked at that and said, well, meh. Because right now, NVIDIA stock down 1.88% ahead of the opening bell. If this new Blackwell chip was going to take the world by storm and change everything and revolutionize the world and all that kind of crap that Elizabeth Holmes said in her stupid turtleneck, the stock would be moving. It's not right now. It's up. It's actually down almost 2%. We've also got a little bit of a shrugging this off at ARM Holdings. That's another big AI darling stock. That one is down 3.25% this morning ahead of the opening bell. And check out Super Micro Computer, trading at $895 right now, down over $100 pre-market. It is 10.5% lower ahead of the opening bell. That's after falling 6% and change yesterday. What's going on at Supermicro? Well, they are diluting their shareholders. Supermicro shares dip as AI server maker looks to raise $2 billion through an equity sale. That means they're creating new shares out of thin air, diluting the value of the existing ones. Supermicro Computer disclosed on Tuesday it will sell 2 million shares. That could fetch about $2 billion, sending the artificial intelligence server maker's shares 9% lower in trading before the bell. The San Jose-based company's shares have more than tripled since January, which makes raising funds through the sale of equity a lucrative option. The gains have outperformed those of Nvidia, which has been behind the relentless AI-led rally in Wall Street this year, thanks to soaring demand for its servers used in artificial intelligence data centers. The shares have, however, lost 16% in value after declining for 3 straight sessions. And based on their closing price of $1,000.68, the company could raise about $2 billion. The issue price for the secondary offering was not revealed. Well, that one is down another 10% this morning. Look, guys, Supermicro Computer, it's a shelf. All right. Yeah, they make server racks and all the connecting hardware for these GPUs. I get it. It's more complex. But what they make, it's not. How am I trying to say this? It's a shelf, guys. They make the racks that the GPUs go on. This is not a several $100 billion company. And I can tell you the history of Supermicro and some of the shady stuff that has gone on at this computer or at this company, shipping products to their customers that their customers didn't even authorize the shipments of just so they could squeeze that revenue into quarters. These guys, all the commentary I've made about Nvidia, these guys are worse. I remember watching the CEO's interview about a month and a half ago, and man, this guy made my skin crawl. He had all kinds of used car salesman vibes. I am not the least bit surprised that this company is diluting their shareholders right now. They are cashing in on the enthusiasm for their shares. And, well, they're diluting all the retail people who piled into this company, even though it's rallied like 1,000% in the last couple of weeks. I'm not at all surprised to see that. Shifting gears a little bit here, check this one out of California. This is from the Legislative Analyst Office for the state of California. The annual revision shows state added fewer jobs last year. Shout out to my moderator, Mish, who spotted this one. Federal officials rebench monthly jobs figures each year to match payroll records. Each month, federal officials survey businesses in the state about their payroll, all that other stuff. So they do this rebench once a year. Each March, federal officials correct or rebench the monthly survey estimates to match the actual payroll records collected from the businesses that year. In most years, the annual correction is small and doesn't materially affect their interpretation of the state's labor market. One important exception is that revisions tend to be more meaningful during economic downturns, with monthly survey estimates often overstating the number of jobs. So they get more meaningful corrections when they rebench during economic downturns. But we're not in an economic downturn, right? This is the best economy ever, the soft landing. We're in the tree in the nest, right? But rebenching recently shows that the state added far fewer jobs than originally thought. The figure below compares the preliminary monthly estimates of job growth between September of 2022 and September of 2023 to the actual job growth reported by the Bureau of Labor Statistics earlier this week. The actual job count in California is 1.5% lower than suggested by the preliminary figures. The corrected data shows that the state added just 50,000 jobs between September of 2022 and September of 2023. The monthly jobs report, which the administration and legislature relied on to gauge the economy during that period, showed the labor market growing steadily, appearing to add more than 300,000 jobs over that same period. And check out this chart here, guys. The solid green line, that is the actual jobs that were reported in their preliminary estimates, the jobs that were reported in those monthly jobs numbers. And then the green dotted line, that's what the number actually was based on the payroll data. You guys notice anything here? Does this look like a meaningful correction to you guys? You think that trend was off by a little bit? Good God. They had initially reported 325,000 jobs added for the period of September of 22 to September of 23. And they've just revised that down to only 50,000 jobs added during that same period, not even keeping pace with the population in the state. Now, I remember last summer watching these jobs reports come in month after month, hundreds of thousands of jobs added. And I remember looking at the oil consumption data, at the energy data, and I remember saying, this does not make sense. Hundreds of thousands of people are working jobs, going to work, driving to work, punching their cards, doing whatever activity they're doing at their job, and yet none of them were using any energy. It didn't make any sense. And the reason why it didn't make any sense is because there actually weren't any jobs being created. They were fake statistics. And here is the rebenching. And look, oh, here's what our jobs numbers say. They just keep going up. It's the best economy ever. The soft landing, yay me. And then here's what the actual payroll data shows. Two totally different stories. The strong jobs market is a myth. It hasn't been happening. And worse yet, this is only counting the jobs themselves. This doesn't make mention of the quality of the jobs, losing full-time middle management, white-collar jobs and replacing them with Uber drivers, OnlyFans, and baristas at Starbucks. That's what the economy has been producing here. Case in point, this story from Unilever this morning. Unilever CEO takes charge with plan to shed ice cream and jobs. It's good to know that, according to Bloomberg, the priority is that we're shedding ice cream. Oh, yeah, we're laying off thousands of people. But ice cream, like, wow, that just goes to show you where the jobs people line up there. Yeah, first, we're going to mention the ice cream. Consumer goods company to create a new entity for Ben & Jerry's. CEO Schumacher seeks to jumpstart growth after a slow period. The new boss at Unilever wants to reverse years of lackluster performance with an ambitious plan to separate the conglomerate's ice cream arm and remove layers of middle management. About 9 months since taking charge at the Anglo-Dutch company, Heinz Schumacher moved to offload a division that is home to brands including Ben & Jerry's and Magnum, which a previous Unilever chief, Paul Polman, dubbed one of the greatest ever success stories in the consumer goods market. It's just one part of Schumacher's wider plan to drive growth and boost profits at Unilever and unpick a legacy of overexpansion, missed opportunities, and failed mergers and acquisitions. The new CEO, who was appointed after activist investor Nelson Peltz took a stake in the company and joined the board, also plans to cut 7,500 jobs, almost 6% of the Dove soap makers' total of 128,000. Again, those are going to be middle management, white-collar jobs, 7,500 of them. Our overall idea is to do fewer things better and with greater impact, Schumacher said on a call with reporters. Ice cream is truly a different business. It is already managed separately than our other activities. So there's another 7,500 people losing their jobs. The anecdata of the layoffs continues to pile up. The downward revisions continue to pile up, and we keep getting these blowout jobs reports saying hundreds of thousands of jobs added when we know for a fact now that that is not true. That's not what's happening. But you know what? This market just loves people losing their jobs. Check it out. Unilever stock is up 2.75% ahead of the opening bell, trading at $49.86, up $1.34 today. Market likes layoffs, folks. What can we say? And I just want to say thank you very much to Mr. Honey Badger. He says government economic data is like sifting your community's sewage to see how well they are eating. Yeah, the government data is a bit nutty, isn't it? There's a lot of peanuts in that government data this morning. I apologize for the visuals. Thank you, Honey Badger. You really paint a picture with your words there. But yeah, you know what? The metaphor holds up, and certainly the smell of the metaphor matches the aroma of these jobs reports. A little wafty. The jobs reports data, not exactly accurate, but yeah. Thank you very much, Honey Badger. I appreciate that one. Gotta love the comments I get on this channel. Appreciate the super chat, the support of the channel, brother. And thank you to my buddy Travis at Real Estate Mindset, whose channel is absolutely bonkers. You may know that by now. He says, thank you for this morning's report. You are most welcome, my good man. And thank you, sir, for taking the time to talk over the weekend about that National Association of Realtors big settlement that came out. Had a great time talking to you and Todd from Sachs Realty over the weekend. Guys, check out that. Okay, so that was weird, and apparently I'm still live. I've never had that happen before. My internet just died, and it came back, and well, I got to close the window out. So no, I am not in the back of an SUV, blindfolded, being taken to an undisclosed location to be interrogated by Nvidia's people or anything like that. Thank you guys for the laugh. Look, since we're still alive here, I got a second wind. Let's finish going through these comments from you guys. Thank you guys. Easy Fix says, good morning, Jack. Do you think we're in a melt up similar to Germany in the early 1920s? If so, do you think a U.S. CBDC would still be the reserve currency? I don't think a CBDC is going to happen in the U.S. first. I think it'll happen in China first. They've already got it. In Europe, I think kicking and screaming, the U.S. will go to a CBDC because there is still a small faction within the government that is still powerful enough. They can still block things to prevent a CBDC from happening, at least right away. So I think the reserve currency status is not dependent on CBDC or not. I think reserve currency status is dependent on how much we abuse the rest of the world through monetary expansion. And right now, as much as we have abused the rest of the world, we're still okay. We're still the reserve currency. We're slowly losing reserve currency status, about 80% of global reserves at the turn of the century. Now we're down to like 56%, something like that. So we are slowly losing reserve currency status, but we're losing to several other currencies. We're losing to Bitcoin. We're losing to gold. So it's not like the yuan is going to take over as the new reserve currency. And I don't think a CBDC is going to really matter one way or another. I do think a CBDC is going to matter as far as it goes with our personal freedoms and the government's ability to manipulate us and to drive our behavior through monetary policy. And there's any number of reasons why I don't like a CBDC, but I don't think it's going to necessarily impact reserve currency status. Thank you, Easy Fix. Thank you, Nashville Pasta Man. He says, collapsing markets are identified by increasing levels of financial complexity. Michael Burry, some money to complicate your Java fund. My Java fund. Wow, there's a name I've not heard in a long time. Obi-Wan Kenobi. Yeah, I do remember. Collapsing markets, increasing levels of financial complexity. I think you misspelled fraud a little bit there, Pasta Man. Increasing levels of fraud, and we certainly see that going at ridiculous levels right now. And unfortunately, crypto, not unfortunately, I mean, I'm in Bitcoin. I like Bitcoin. But with crypto in a new bull market, we're going to see more and more scams and fraud pop up. I mean, there's this clown on Twitter with the stupid sunglasses going around the internet, taking pictures of rented stuff, pretending to be rich. I mean, these are the signs that we get when the market is too frothy. And I think it's still getting worse, Pasta Man. I mean, you can see the same numbers I can. The fraud is still getting worse. So, yeah, I agree with that comment wholeheartedly. And thank you, sir, for the support of the channel. Thank you, Brett Green, who says, this just in, springtime is in the air. Cannot get here fast enough. I cannot wait for Janu-Feb-Mar to be over. I'm ready for the warm weather. I don't know about you guys, but thank you very much, Brett Green. And I agree, it is in the air. Thank you, Jana Williams, for the super sticker. They don't show up on StreamYard, but I appreciate the super chat, the support of the channel. And Vegas Schmitty says, oil is up, inflation is up, banks are broke and not lending. That last part, the banks are still lending. Believe it or not, the banks are still lending. They were expanding the money supply, at least for the last couple of months. But I agree, the banks, they got big problems. Maybe not broke, but insolvent, probably the better word. Consumers are more broke and can't borrow. Again, Schmitty, yes, the consumers are broke, but they can still borrow. They can still go get a buy now, pay later loan to pay their rent, to buy their groceries, to buy stupid consumer crap. I mean, the incredible thing is that debt is still available to them, Schmitty. I don't know why they're not going to pay it back. Well, moral hazard is why. The banks are just packaging that crap into asset-backed securities and selling it to middle-class pension funds. That's why they can still get it. It's moral hazard. It's fraud. It's the increasing levels of complexity that Nashville Pasta Man just mentioned. I agree with the premise of everything you're saying here. The oil is up. The inflation is up. The banks are broke. The consumers are broke. But the one thing is the credit is still there. The lending is still happening. It defies logic. It defies reason. It defies ethics, in my opinion, but it is still going on. And that's why this market could keep running. There's still that monetary expansion happening. This house of cards is going to burn on the way down. That I agree with as well, sir. Thank you very much, Vegas Schmitty. I appreciate the super chat, sir. And thank you, Cole Marsh, who says universal basic income is being rolled out. Oh, God. I hate you. We have a problem that's been created by easy money, by cheap interest rates, by monetary expansion, by government debt and money printing. You don't solve that problem with even more monetary expansion and even more easy money, right? What could be easier money than paying people for nothing? And that's what universal basic income is. And if all the problems in our economy have been created by easy money, making the money easier is not going to solve those problems. All right. Universal basic income is nothing but finishing off what is left of the middle class to drive them down into poverty where they are forever hopelessly dependent on the government for their survival, and thus very easy to control. I pray we never roll out universal basic income in this country, in this world. It is a terrible, awful idea, especially when you combine it with an open border policy. Good God, the mayhem that would come out of that. But hey, that's just my take on that. Thank you very much, Cole Marsh. I appreciate the super chat, sir, and the support of the channel. And thank you, everybody. I apologize for the technical difficulties. The internet went down and came back, but thank you guys for sticking around through the end. Thank you for all the super chats and the support of the channel. Thank you to all my channel members and Patreon supporters. I appreciate everything you guys do for the channel. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.